As some of you may know, BNN Bloomberg is now into its 25th year, and as one of the original team members, I remember a lot of big moments in our history. One occurred after an entrepreneur named Kevin O'Leary came on air for the first time. That's because he did something a bit unusual. He shared his opinion. Now, keep in mind, this was back during a time when Wall Street analysts had been muzzled by regulators for overhyping internet stocks. So a lot of people were scared to share opinions on investments. Not Kevin. As an investor, he wanted to cut through the talking points CEOs dished out about their companies and give our audience what they really wanted to know, namely, should I buy or sell? And remember, this was before we measured responses by monitoring social media. Instead, it was phone calls and emails, and we got a lot of them. And whether people liked or didn't like what they heard, they were always curious about what he might say, and that is still the case 2 decades later. So we are pleased to welcome Kevin O'Leary back to BNN Bloomberg, who will be with us for the full half hour. Nice to see you.
Great to be here. It's just wonderful to be back in this place. I mean, it's like my old stomping grounds.
It is indeed. Do you remember those first TV appearances?
I do, and I don't think much has changed in terms of the controversy. You have to put it out there, and I've learned since then you can't make everybody happy all the time, so why try?
And you've never really shied away or been scared of opinion. Where does that, or sharing your opinion, where does that come from?
It comes way back from my mother telling me when I was a teenager, if you always tell the truth, you'll never have to remember what you said. So I just tell my truth, and some people don't like it. I don't care.
There you go. Well, give us your truth on the situation for the economy. Everybody's trying to figure out where we go from here, what happens with interest rates. You spend a lot of time in the U.S., obviously, as well, so there's a separate narrative there. But what's your assessment of what's going on right now?
Well, I read a great op-ed piece yesterday in the Globe and Mail by Dan Davio, the CEO of Canaccord, and I thought he hit the mark on a really important issue for Canadians. This concept of the competitiveness of nations, the competitiveness of provinces or states. Because post-pandemic, something unique has happened. I've noticed this as an investor. Let's say you're a fantastic tech team out of Waterloo. I mean, you know, Waterloo's legendary, micro-robotics, and you want to raise $200 million for your startup. Now, as an investor, with the proposed changes to the tax landscape of Canada, which is a policy decision that, you know, the country has to make, you have to think about this. Why would I nexus the headquarters of that new hot startup, that growth company? This was Davio's point. Why would I leave it in Ontario where the taxes are no longer going to be competitive? Why wouldn't I just move that to Texas or to Florida or to North Dakota if it was an energy tech deal, which is exactly what's happening because we know that 40% of the people in these companies don't have to work at HQ anymore. So you leave the tech team in Ontario or in Alberta, wherever it is, and you build the company outside of a punitively taxed jurisdiction. This is bad news for Canadians, and I think we should all wake up and understand policymakers do a lot of damage. It reminds me of the early 90s when Bob Ray came into Ontario, and we were the fastest growing software company in Ontario. We moved it to the U.S., created tens of thousands of jobs, raised billions of dollars, and not a dime of it, or one job in Canada, because Bob didn't believe that it mattered. He always thought that every company, and I'm not criticizing him now, it was a long time ago, but I'm just pointing out bad policy creates unintended consequences. Ray's policy was very damaging for Ontario in real estate and tech. I see coming something very damaging for the Canadian economy.
So at the end of the day, do you think Ottawa should reconsider this capital gains tax change that's been announced?
Yeah, you know, I hate to get into partisan politics, and I don't mean to at all in this statement, but I've been very vocal about policy in Canada. I think Justin Trudeau is a wildly successful politician. I really do. I think he's a horrible manager. I think the policy that he's putting forward in these different mandates within cabinet are from mediocrity. These people don't. It's so hard to say these words, but again, it's true. And Canadians should start thinking about, I don't care who is the prime minister, but they have to have the concept that Canada is a very important economy. We're the richest country on earth by capita, by natural resources, and it feels to me, as an investor, and as I talk to foreign investors to try and attract capital here, they think our country's run by idiots. Sorry.
And so are you reconsidering some of your, I mean, you invest in all sorts of stuff.
Yeah, I do.
Here. Are you actively trying to figure this all out for yourself?
Yeah,
as well?
I read Davio's piece and I said he's right. I mean, now I have to contort my investment strategy. I want to invest in Canada, but I don't want to be taxed at an uncompetitive rate that makes me in the industry, you know, My cost of capital goes up. So I think what we should do is not raise, we're right now in the middle. We're right in the sweet spot. Raising taxes now is a bad idea. It's bad policy, regardless of the partisan politics. Doesn't matter. But he's right. It's going to make people like me and others say, wait a second, let's just hire those engineers up in Canada, but let's put the company somewhere else where it's competitively taxed.
Well, we want to keep talking about the investing story. It's one we're watching very closely here. We're going to take a break and talk a little bit more about the investing landscape with Kevin, and obviously not just investing in the stock market. Over the years, if you've seen his Shark Tank appearances, he thinks creatively about the ways he invests in businesses. We'll be right back with more after this short break. Back to Morning Market. It's one thing we know about the investing world. There are lots of options. Warren Buffett has talked about that being a good thing. He's said it's like being able to stand in the batter's box, waiting for your pitch and not having to worry about strikes. Of course, figuring out what kind of pitch you're looking for is another story. Because in the world of investing, we've got stocks and bonds and ETFs and currencies and real estate, cryptocurrencies. Increasingly in today's culture as well, there's a curiosity around investing in startups. And some of that is rooted in Silicon Valley, where certain venture capitalists have become as wealthy as the founders they back. But on shows like Dragon's Den or Shark Tank, those also help to take startup investing to a new level. And we wanted to talk again with Kevin O'Leary, chairman of O'Leary Ventures, about that. It has been very interesting to watch. You were saying Dragon's Den is now into season...
I think it's just they're just shooting 19 right now, going into season 20. That's extraordinary for a Canadian show. I mean, they've really hit a nerve with Canadian entrepreneurs. They've done an amazing job. I was so proud of my legacy there, working on it for years.
And let's talk a little bit about your investing philosophy. Outside of just ROI, what is it you're looking for in a business when a business comes, in front of you? Might be on paper, you might be looking at what the business represents, might be talking to an individual. What are you looking for?
So I now have empirical data of over 25 years of investing in startups and venture capital, which is a portion of what I do. It's not all of what I do, but it's an interesting part. And here's what the data will tell you. If you look at a 7-year cycle of a portfolio, you make an investment in 10 deals. And then you're going to have to wait 5 to 7 years to see where you're going to get your yield from. Traditionally speaking, you would get 2 out of 10 to provide all your returns. And you would think you would know which 2, but you never do. And that's the issue. But shows like Dragon's Den and Shark Tank in the US have changed the model a little bit, because the reason most companies go bankrupt in the first 36 months that are startups is their customer acquisition cost is never below the lifetime value. A fancy way of saying they go bankrupt advertising. They can't get customers. But when all of a sudden you get a Dragon's Den show and 36 million Canadians see it over a year through syndication, or 110 million Americans see Shark Tank, all of a sudden these companies have zero customer acquisition cost because it's an 8-minute infomercial on primetime TV. And so we found our numbers went up to 4 out of 10 made money. And so these shows are very important in supporting entrepreneurship. And there are great Canadian entrepreneurs as there are great American entrepreneurs. And it's on in 42 countries now. So I'm very fortunate. This platform has made me the most hated guy in Austria. It's fantastic.
You've also introduced people to royalty streams, I think, a lot of places around the world. I know you've said perpetuity is one of your favorite words, but it is interesting when a lot of people get introduced to investing, I think, buy a stock, buy a bond. Why has that always been a very important, outside of it generates a lot of cash potentially for you, why was that always an interesting investment offering, if you will, that you really leaned into?
Because I'd argue that a royalty stream in perpetuity is better than equity. And here's why. Let me take a very simple example. A company called Wicked Good Cupcakes. It made cupcakes in a mason jar and shipped them to people. Everybody thought it was a joke. I invested in it. It was a wild success. Hickory Farms eventually bought it. I didn't have any equity, but I had the perpetual royalty of 7.5%. So Hickory Farms came to me and said, hey, listen, let's talk buyout on your 7.5%. And I said, why? I'm happy. I'm getting a check every month, and I love the cupcakes. That was a more interesting negotiation than had I had the equity in a non-control position. And so I teach a lot now in colleges, up here in Canada as well, in Harvard and in the US. I show these structures, and you have to think outside of the box when you're a venture capital investor, because it's return of capital that's more important than on capital. Unless you get your money back, you never get a return. Royalties guarantee cash flow, as I like to call it. Cash flow. I love that word.
You mentioned equity, so let's just talk a little about the stock market.
Right.
I mean, back in those early days when you were, here with BNN, and that was the era of the income trusts as well, and that's a model where investors are getting a lot of the income streams. But when you're looking at the stock market and you're looking for investment ideas in the stock market, what is your philosophy around that by comparison?
That's all about diversification. My rule is very simple, because in Canada we enjoy access to the world's largest market, the US, and our own. So the rule is very simple. This will work for you day in, day out through every market cycle. No more than 5% in any one stock, no more than 20% in any one sector. Now, we do not have 11 sectors in Canada, so you must put some of the S&P into your portfolio. Canada is very resource-based. We have the world's envy of our banking system. So I'm a huge shareholder of the Canadian banks. But I do it all through ETFs. And so for me, I'm making sure that I never have an overweighted position. A good example would be when Tesla came up. I didn't want to buy it, but my son got a job there. And he was bemoaning me, saying, why don't you own some of the stock of the company I work for? I said, well, I think it's overpriced, yada, yada, yada. He said, just buy some and hold your nose. That ended up being, I bought it way before the splits, but every time it hit the 5%, I sold it down to 5%. It did nothing except go up for years, and I kept it at 5%. I got all my capital back, and I had zero cost base. And when it did have its decline, I didn't suffer any losses because I'd stayed to the mantra of no more than 5% in any one stock, no more than 20% in any one sector.
So that's a very important point at a moment like this, where a lot of people start wondering, not with Tesla this year, but with a number of stocks, whether things are too frothy out there, especially when it's up against this theme like AI, and people are like, this is transformational, it's going to change the world. And you might be sitting on a nice gain if you were lucky enough to get into some of these stocks, but you're wondering the risks of getting off the table. But you're saying there's no harm in taking some profits along the way.
But it's not human nature to sell your winners. And so the biggest mistake I see in portfolios, and I look at all kinds of people's portfolios, including incredibly wealthy people, is you have this massive concentration of their wealth in two positions. And I say, why aren't you selling some of that off? Oh, I don't want to take the capital gains hit. Never let the tax tail wag you as an investor, because if you're paying taxes because you made money, what are you complaining about? But you've got to keep that diversification. So the key is to, yes, sell your winners down to 5%, and understand that every hot stock eventually gets cold for millions of different reasons. But you only learn that through the experience of losing money. So I really try and get people to understand the concept of diversification in equities.
And then just a final question this block on age. So people are investing at all ages. A lot of times we hear about, if you're younger and you're investing life, you should be putting more capital to work so that that'll pay off in the future. What would you say to people who are just starting out, even if maybe they don't feel young, but they want to try to figure out how to figure out the investing code?
I still say diversification across fixed income and equities. So the classic is a 60-40, 60% equity, 40% fixed income. But during the zero interest rate days, I did move to 70-30. And that served me well because, you know, there was a time when, and I don't consider interest rates today to be punitive at all, because I remember rates at 16%. So this to me feels very normal. It makes sense to always have a little diversification. But if you're going to get into fixed income, most people don't understand how the covenants work on a BBB bond. Again, an ETF is better. I mean, I actually read bond covenants. I'm a fixed income guy. They are very complicated. And if you don't have that training, don't try.
Yeah, they're not leaflets.
No, but you have, I mean, I do triple B, single A, all the way up to, I mean, the whole point is I'm trying to make that 5.25 right now that the market's offering me and keep my duration under 5 years.
Okay, well, we're going to take a quick break and continue our conversation with Kevin O'Leary, who, by the way, last time he joined us, he mentioned if TikTok is up for sale, that might be something he would be considering as well. We'll talk a little bit more about that. We'll be right back with Kevin O'Leary. Watching Morning Markets, and we are back with Kevin O'Leary. And in our final minutes here, I just wanted to remind Kevin, our audience, that if TikTok is for sale, and there's a lot of buzz around that right now, that you have raised your hand. What do you make of the situation around TikTok right now?
I'm very close to it. I spent a lot of time in Capitol Hill talking to both sides. This is going to be the first deal in history where you need the pen of the president, whoever that person will be, post-November, to actually get the deal done. You're going to have to embed the DOD, Department of Defense, to scrutinize whether or not the supreme leader is getting any data out of the new TikTok. But my advantage on this deal that I've pointed out to, because it's going to cost around $30 billion cash. That's sort of the number people are throwing around. There's 7 million U.S. businesses on that platform generating 11.1 billion of revenue. They're all Shark Tankers. They're all in their 20s and 30s, 2 generations of Shark Tank. They all know who I am. I'm going to create the largest equity crowdfunding deal in U.S. history. I think I can raise between $5 and $7 billion from that base alone. So it's a very interesting deal. There's lots of competition. But in the end, you're going to have to attract sovereign wealth. I think my plan is the best one, and I think my ability to execute it is the best. I'm talking my own book when I say that. But TikTok, even though the company will challenge the decision Congress made, will not win because it's an issue of national defense, national security. So the judges, even at the Supreme Court, are going to err on the side of Congress. They should run a parallel process. They haven't started yet. I'm going to be a buyer. I will be the buyer, I think.
On the political front, I mean, we've got an election, presidential election coming. What are you watching heading into the fall?
So the reason you should care, I know it's a little perverse right now with the porn star wars going on in New York. It's unusual not to have policy debates. We don't have them yet. We're just hearing all this crazy stuff in New York. But if you look at the polls, right now it's a 50-50. You can't really call who's going to be president. But if you have a 50% chance, what sector of the U.S. economy would you go long if you thought Trump was going to be, that administration came in? Now, that administration is pro-energy, it's deregulatory, it's tightening on immigration and border security. So these are all the elements. But the one I find most interesting is if you know you're going to get a more pro-business environment around the regulatory area of federal law, it's the Russell 2000 that's going to give you the best bang for the buck. Now, unfortunately, 2/3 of the Russell 2000 doesn't make money. So there's only about 380 companies you really care about. You will find them encapsulated in an ETF called OUSM, full disclosure. I helped design that, then it was sold to Alps. So they own that now, but we still index for it. It's all of the profitable companies in the Russell 2000. So it pays out a distribution every month, and you get better policy domestically. They're not worried about international sales. They're domestic, U.S. domestic companies. I'm very bullish on what happens to those mid-cap companies.
We'll watch them closely. Kevin, good to see you. Thanks for making the time today.
Thank you. I really appreciate it.
Kevin O'Leary, chairman of O'Leary Ventures, joining us this half hour. The profits in the pizza business is something we'll explore next. Pizza out with its latest quarterly results. We'll talk about the growth plan with the CEO.